Hello, everyone. The statistic of the day is 70%. Now, it may be difficult to imagine needing help to complete a simple task like eating, bathing, or getting your clothes on, but throughout our lives, it's highly likely that we will experience at least one injury or serious chronic illness that requires long-term care. And then the question becomes, how am I going to pay for it? The astounding fact is that 7 out of 10 adults will need some form of long term care services in their lifetimes, and that's the 70%. Welcome, everyone. I'm Patrick Seaman. Today, we're going to be discussing long term care in retirement. A lot of fun stuff, I think, like how to pay for a nursing home or home health care. Maybe it's not that much fun, but you may be surprised. We'll look at several different innovations and insurance products that may surprise you when I say it could cost you very little and save you a lot, or it may cost you way too much if you're not up to speed. You don't want to miss this, so stop procrastinating because planning for retirement shouldn't be a mystery and it should be simple, and that's what we're here for. Now, I'm here today with my guest, Alicia Barnett. She's kind of my go-to expert on everything long-term care. She's a national speaker, goes around the country and talks about long-term care. Lives outside of Charlotte, North Carolina, and works for Financial Independence Group. And I want to thank Alicia. And Lisa, thank you for joining me today. And I want to welcome you.
Thank you so much. I'm so glad to be here.
Well, first off, I kind of want to start with one question, which is, what is long-term care and why should we even care about it?
Absolutely. That is a great question. And it's a subject matter that I'm very passionate about. And I really am here to really help people. And long-term care is really about aging, and it's about aging in place and aging comfortably. If we all live long enough, we could become frail and need some type of assistance. So long-term care is essentially, as you mentioned, it's all about activities of daily living. What does that look like when you age in place? What does it look like when you might need some type of home health care services? So it really is about aging gracefully. And of course, we have solutions that can help you do that. So again, long-term care is about activities of daily living. And when we need care one day, when we become frail, it's really long-term care is about the consequences of not having a plan in place, because it's really about family first and finances. And if you don't have a plan, you've essentially allocated everything. In other words, if you haven't allocated something, you've allocated everything. Which asset, for example, would you really take to pay for that long-term care services? Since the majority of us will need some type of care, how is that going to affect us financially, and how is that going to affect us with our family? Long-term care doesn't bring families together; it tears families apart. And it's really why I'm so passionate about putting solutions in place to keep you from avoiding those unexpected costs and consequences to your family.
I think some of those solutions are pretty simple, and we'll get to them in a second. But can you first, maybe before we get into any solutions, can first address kind of how Medicare or maybe Medicaid pays or does not pay for long-term care?
Absolutely. That's another great question. And a common misconception is the government's going to take care of us. Medicare, for example, you have to be hospitalized at least 3 days and you have to be rehabilitating. So you have to be getting better. And it typically covers only up to 100 days of skilled care. So it's really short term care, not long term care. And then when we're talking Medicaid, you have to actually spend down your hard earned assets to even qualify. So it's means tested. If you're married, you could potentially leave your spouse impoverished. And it typically doesn't cover care in the home. It's typically skilled care only. And I don't know about you, but I'm really not interested in going into a Medicaid facility if I can avoid it by giving up my assets and losing control, and maybe not even having choices when it comes to the different facilities out there that are available.
I know I had a client once talk to me about a job he had, which is he worked for Jobs and Family Services and talked about Medicaid. And there's something in Ohio, at least, called the Medicaid waiver, which would pay for home health care or for assisted living. But the challenge, he said, was for home health care, they couldn't hire anybody. They could not find anybody. So while you might qualify for it, there was no one to come out and take care of you. So, but to qualify for Medicaid, I know there's several different qualifications that have to do with income, and with assets. But I think this is, it's very difficult to qualify, and I think this is really why we're talking about long-term care, and I think it can really be a threat to your retirement. But another thing we talk about is Medicaid planning, and there's really two sides of Medicaid planning. There's pre-planning, which is something you do, way before you may even need long-term care, and then there's crisis planning. Yeah, I mean, is that something you can discuss or talk about? I know that's not necessarily your area.
Absolutely. So really what I'm here for is kind of Medicaid pre-planning, and that would be putting a plan in place, in my opinion, that will take that risk off the table so you don't have to spend down your assets because you will be impoverished. Again, it's not really my forte. A lot of people will put money into trust and they'll transfer money out of their names. And again, that's giving up choices. So my recommendation for pre-planning, I think of it more as putting solutions into place like insurance contracts. And that could be anything from, traditional long-term care to asset-based long-term care to even self-funding and moving some of that money. So there's a lot of different ways to skin that cat. But again, pre-planning, in my opinion, is best because if you wait until the last minute and you're planning reactively, then it might be too late to transfer those assets and you'll essentially have to pay for it on your own unless you're going to spend down your assets and qualify for Medicaid.
And I think that's the big part that people have a problem with is you have to spend down your assets in Ohio. Um, they have a limit of, I think it's 140, 150, about 154,000. I have it right up here in Ohio. So what that means, no matter how good you are, your retirement's looking prior to your spouse needing long-term care. A community spouse is left with somewhere usually between about $31,000 and $154,000 in assets. One house, of course, one car, and roughly about $2,900 monthly stipend. And to say the least, it's not quite kind of that rosy picture of retirement that a lot of people were looking forward to. But this is really why we're talking about long-term care. It can be a huge threat to your retirement. And I always kind of say this, a bit tongue in cheek, but it seems to me you're better off dying than needing long-term care. At least if you died, you'd leave your spouse, they'd be able to inherit all of your assets, your pensions, higher of your two Social Security benefits. But so the fact is, long-term care can destroy a lifetime of savings and potentially leave no money to your heirs, excuse me. And I think there's a lot of different ways to pay for long-term care. In fact, one way I know a client told me I hadn't heard of was ask your children, which kind of made me laugh because I think about this. For everyone that's out there, you can test this by picking up your phone, dial your children's number and, see what they say, right? See how that goes. But in fact, is it might be an option in part, but there might be a little bit of help. I know for my parents, there's 8 kids, and we did help take care of our parents. It worked out very well, but we still had some home health care providers. But the fact is, your children are not likely going to be your full-time caregiver, nor would you want them to be. So, Alicia, can you kind of go over some of the ways that you can pay for long-term care without relying on Medicaid?
Absolutely. There's really two primary ways that you can pay for long-term care solutions, or two types. They're not the only ones, but they are the most popular, and that would be traditional long-term care and asset-based long-term care. I like to use the analogy owning your policy versus renting. So traditional long-term care is really the old school type of way of taking the risk off the table. It's the cheapest way to buy the most amount of long-term care coverage. However, like renting, rates can go up. If you don't use it, you lose it, and there's really no exit strategy. So it's still a viable option, but there are newer solutions, and what I like to call are asset-based long-term care, which is owning your contract again versus renting. You have a benefit whether you live, whether you quit, or whether you die. And these are typically written on life insurance or annuity chassis because the government has allowed certain life contracts or annuity contracts to be accessed tax-free for long-term care, and you get pennies on the dollar leverage for that long-term care services. And if you die and don't need it, again, there's that death benefit. So it's a much more viable option in today's solutions that people really like a lot better than renting. Does that
So
make
can you kind
sense?
of, yeah, can you kind of break down, you said life insurance and annuities. Maybe kind of separate those two out and maybe use some examples. Maybe to first talk about the life insurance solution, which I know can be very complicated. So good luck explaining that. And then the annuity solution, I'd be happy to give an example of that because I just recently did an annuity with a long-term care benefit. But please go ahead.
Absolutely. So there's really four ways that you can fund a plan. Four types of funding mechanisms. You can use cash or cash equivalents. So, say, for example, you have money sitting in the bank or CDs, things like that. You could reposition cash into a life policy, and it's a lump sum payment. So, for example, maybe you put in 100,000, and maybe it gives you around 500,000 for long-term care benefits. And then, of course, if you die and don't use it, you've got, for example, about $130,000 death benefit. Now, it's not, it's not the greatest life insurance vehicle, but it is a great long-term care vehicle because it's giving you pennies on the dollar leverage, and everything that comes out of that life policy comes out tax-free for long-term care. So it's going to pay for home care, it's going to pay for assisted living, nursing home, etc. But if you don't use it, you don't lose it. So that death benefit will go to your beneficiaries.
And what I like about that too, as well, is when you talk about traditional long-term care insurance, I've seen that recently. A couple companies have raised premiums where in life insurance, your premium is level. It's what
That's
it
right.
is. It's what it is for the rest of your life, unless you pay it all up front, like you had just said. So there's not going to be any surprises.
Exactly. And just like traditional long-term care, you can fund those life insurance policies anywhere from, for example, a 5 year. So meaning you pay in for 5 years and no more payments, all the way to a paid to age 100. So from a cash flow perspective, the longer you stretch out those premiums, the lower they will be, and from a cash flow perspective, you don't have to give a write a big check for 100 or $200,000. So we typically see a lot of payments, for example, like a 10-year pay. So you pay in for 10 years, you're done, and that might look a little bit differently. Instead of 100,000, maybe you're putting in $10,000 a year for 10 years, as an example, and you still have similar leverage, but you have the death benefit, you have the guaranteed premiums, and you even have an exit strategy. So a very viable alternative to traditional long-term care. And the major difference is it's on a life insurance chassis, and again, you have the benefit whether you live, whether you quit, or whether you die. And you can even use, I don't know if you know this, and most people don't, you can actually even use retirement funds, so qualified dollars in these plans. Now, you're never going to get out of paying Uncle Sam, but what you can do is more tax efficiently pay for a long-term care policy. You get the pennies on the dollar leverage for care, and again, tax-free long-term care benefits, and you still have a death benefit if you don't use it. So it's again, a great alternative to traditional long-term care. As long as you're young and you're healthy, or in reasonable health, the life insurance chassis is a good way to go. Now, you mentioned the annuity as well, and I'll let you give your example, but it's certainly a great way to fund a plan, especially if you have existing annuity contracts that you're not going to turn on the income rider. If you never are going to use that at your rainy day funds, you can transfer that money into an annuity and everything comes out tax free. So, for example, you put in 50, it grows to 100. Normally, when you take money out, as we know, you have to pay taxes on that $50,000 gain. Just by repositioning that money from your left pocket to your right pocket, anything that comes out for long-term care comes out tax-free. And depending on the solutions out there, you can get anywhere from 2 times or 3 times or 4 times your dollar for long-term care. So, for example, you put in 100, it might give you 300,000 for long-term care purposes. So it's also a great solution for that rainy day money that you're not going to turn on for income and you don't have a plan in place.
Just to give you basically said exactly what I was going to say. But yeah, for example, the one client that I had, it was taking about 100,000 of their assets, and again, just kind of putting it from one pocket to another pocket. So it was at a brokerage account, and we took that money and we put it into this annuity. And in that annuity, so you know what that is, it's like an investment, safe investment with an insurance company, and that 100,000 is going to grow with interest every year. And if they never need it, that money will be there for them to use, or they could leave it to their children or to their heirs. So they're always going to get something out of it. But if, let's say, 10, 15 years down the road, they find themselves in a situation where they do need, whether it's home health care, assisted living, or nursing home care, all the different types of care, all they need to do is just get a letter from the doctor that says they need help with what, 2 out of 6 activities of daily living. And now suddenly $300,000 would be available to them. But it actually goes beyond that because every year there's interest that it grows, that $100,000 grows. It isn't just 300,000. It's 3 times, and actually it's a little bit more than 3 times of whatever that accumulated value is. So you think about that, and 20 years from now, if they needed it, that 100,000 may grow to 200,000. And, they might have, $600,000 available. I know I'm not the details are a little bit more difficult than that, but that's basically the idea that that pot of money for long-term care is growing. And I think what's so important, whether you're looking at the annuity side or the life insurance side, what I try to do for my clients is I'm trying to give them value and saying that, and people always think of return on your investment. What's the return you're going to get? Is it 5%? Is it 10%? And part of the analysis is to say, look, whether you use it for life insurance, a death benefit, or whether you use it for long-term care, or if you need the cash, like out of an annuity, just to pay for your living, because you never needed it for long-term care, what's your return on investment going to be? And to me, it's pretty amazing to see kind of the results of just that value on your money. And I think that comes back to what I initially said at the beginning of this presentation, that when you are thinking about this and looking at different products, you can find ways that are really not necessarily going to cost you very much. You may say, well, no, it cost me $100,000 in premium. But the thing is, you have that $100,000, whether it's sitting in your brokerage account or in an annuity or in life insurance. What's your real return going to be on that money? So everybody's situation is different, but ultimately that's the goal, is to me, to optimize, to maximize what you have and get the most out of your money, try to protect your money, so forth. Any comments on that?
I would agree 100%. And as I mentioned, if you haven't allocated something, you've allocated everything. You're going to spend that money anyway if you need care. This is just a more tax efficient way to do that. And again, that pennies on the dollar leverage, and it frees you up. So instead of taking 300,000 of your own money, you're just using 100,000 of your own, and you can use that other 200,000 for income, for example, or accumulation. It's kind of almost like an umbrella policy for all of your other assets. And it's still an asset on the balance sheet. You're just moving it from your left pocket to your right pocket.
Hey, so one thing you mentioned were taxes, and I wanted to ask you about that. So let's say someone did have that life insurance policy, where you'd said they had a $500,000 long-term care benefit. Let's say they need long-term care. When that money comes out, it's coming basically from the death benefit, right?
That's correct.
Well, sometimes it's out of the death benefit. Is that money tax-free when it comes out?
It is. Everything that comes out of these annuities and life insurance contracts that we just described will come out tax-free for long-term care. And that's whether you're using qualified money or non-qualified money, meaning
Yeah.
if you haven't paid the taxes on it, that's going to be your qualified fund. So when the money comes out of the qualified account, you have to pay taxes on it. But the long-term care benefits, day one, dollar one, all come out tax-free. So again, it's a more tax-efficient way to use that money. And the same with life insurance. Everything comes out tax-free for care. The death benefit is tax-free, and the walkaway will be tax-free unless you have gains in the contract. But these are typically for long-term care first. The life
Yeah.
insurance is really secondary.
And that's kind of interesting because if you look at it, if they had a life insurance policy, and to keep it simple, they put 100,000 in it, and the death benefits, whatever, 400,000, and the long-term care benefits 400,000, assuming they're the same. Um, if they die and their heirs get that 400,000, there's a $300,000 gain. So it went from 100 to 400,000. They don't pay a penny of tax on that, which just to me is amazing.
Oh, yeah.
But it's the same thing. And then if they need it for long-term care, and let's say they use $200,000 of that $400,000 death benefit, they didn't pay any tax. Now, what happens if they die after using $200,000 of that death benefit?
Great question. In that example, if it's a $400,000 death benefit and 200 comes out for care, then the remaining 200,000 will go to the beneficiary tax-free.
Tax-free. That's excellent. All right. Any other comments? I think I want to kind of wrap this up. We usually try to keep this pretty short.
No, I appreciate you being on here today. What I can really recommend to anybody listening is even, go talk about it with your family. One of the hardest things is reactively dealing with a long-term care event. Even if you don't put a plan in place, obviously it's going to be more cost effective to have a plan in place. But if you don't, what I recommend is go and put a written plan of care together. Who do you want to take care of you? Where do you want to receive your care? Again, the $1 million question here is which asset would you liquidate first if you don't have a plan? Because your money is your plan. So put that written plan of care or investigate the options that are available for you because it's not a one size fits all approach. Five of you might have five different solutions. So go investigate those options, put the plan in place, and make sure you tell your family. Again, reactively having to deal with that is really, it's hard enough because you're having to care for a family member, but emotionally it's very difficult. So being prepared ahead of time is really the way to go, and it will help your loved ones. It will keep them together because I've always said long-term care doesn't bring families together, it tears families apart. So preparing will help you avoid the consequences of not having a plan in place.
I think not only that, but also having all the proper legal documents in place. I recently, several years ago, had a client who suffered a stroke and ended up going to a nursing home. And as a result, his spouse needed to access funds from his IRA, but she didn't have a power of attorney. So it took about a month or so by the time he was capable of meeting with an attorney, signing that power of attorney, and then she could get access to the to his IRA. It wasn't a dire situation, but it was challenging, you know. Well, I want to thank you so much for joining me today, Alicia. If anyone has any questions, would like to set up a time to meet, even talk to Alicia, I'm sure you'd be available. Feel free to contact our office or email me. We hope this webinar was helpful, and we just want to thank you so much for taking the time to be with us today.
Thank you so much. Great to be here.